Hi, I'm Thomas. Welcome back to the course Financial Management. Today's topic is ratio analysis. In performing financial statement analysis, we have several tools available, one of which is ratio analysis, and we'll consider a few others briefly before moving on. Horizontal analysis is looking at statements across time, usually looking at a growth or a change component. If we see, for example, our year-to-year change in sales is 10%, and the industry year-to-year change is 15%, then we would ask the question, why didn't we keep up with the industry growth? Vertical analysis is moving up and down one period of financials. For example, I might look at my operating expenses as a percentage of my sales for a period. Ultimately, that's only meaningful if I compare that to the same number for another period or the same number for another company. So within my company, I might calculate operating sales as a percentage of sales, my vertical analysis for 2015 as 20%. And then if I see in 2016 the same percentage is 25%, there's a change, and I want to investigate why have my expenses gone up as a percentage of my sales. Comparable companies analysis means that when we want to understand what is the meaning of the changes in our numbers, or what is the meaning of how the relationships in our numbers work, we really won't understand that very well without a comparison, and the best comparison is companies like ours. In other words, similar industry, similar stage of life cycle, so we wouldn't want to compare a furniture company that's been around for 20 years to a technology startup. Those would not be in any way comparable. We want to compare two companies similar to ours, both in industry as well as in age and size. A very large company in an industry isn't usually completely comparable to the same industry, but looking at a company that's a much smaller size. And finally, ratio analysis. We're going to look at several categories of ratio analysis. Ratio analysis simply means relationship analysis. We'll have numerous ways to look at how numbers from our financial statements relate to each other, and what is that information, what do those relationships tell us? Our categories of financial ratios are liquidity, leverage, efficiency, profitability, and market, and we'll see examples of each of these, discuss the general meaning of the category and the importance of each ratio as we proceed. Liquidity ratios tell us the ability of a company to be able to pay its obligations, to be able to come up with the cash to cover its obligations as they come due. And the two main liquidity ratios are current ratio, which is the ratio of current assets to current liabilities, and the quick ratio, which is a group of current assets, cash, investments, and receivables, summed and compared to current liabilities. Both of these ratios give us an indication of what our liquidity position is, how quickly can we convert assets to cash so that we can cover the liabilities that are coming up due. In both of these calculations, we're looking at current numbers, so we're focusing on assets and liabilities that relate to a period of 1 year or less. Our leverage ratios tell us how much debt type of financing are we using relative to equity financing. Debt to equity looks at our total liabilities relative to total equity. A company that has a low debt to equity ratio is primarily funded with equity. A company with a high debt to equity ratio has a higher amount of liabilities, a higher amount of debt funding. The higher the debt to equity, the higher the leverage and the higher the risk, because more of the capital for the company is coming from non-owners who sooner or later will require repayment. And anytime repayment is required, whether that's now or in the future, that is a risk factor for the company. Interest coverage tells us what the company's ability is to pay its debt obligations, the interest payments due to its lenders. This is income before interest and tax from the income statement divided by interest expense, and we're usually looking for a number that 4, 5, 6, something, let's say 4 or higher, which gives us confidence that we have a good amount of operating income coming in to be able to cover the interest expense that is due. When that ratio drops below 4, we run the risk that a negative change in our operations could drop operating income below the level of which we need to be able to pay our interest, and then we have a default situation. We haven't paid our obligations, and we have a default situation that could lead to a legal issue. Efficiency ratios give us an indication of how efficient the company is in using its assets. Asset turnover is sales divided by assets. So given an asset base, how much sales can we generate in a 1-year period? Days sales in receivables gives us an indication of how long are our credit sales outstanding before we collect in cash. This is our receivables balance divided by 1 day of credit sales. If we don't know the credit sales amount, then we'll just go with the assumption that all sales are credit sales. But if we're given a sales total and a credit percentage, then we can adjust the sales so we're only considering the credit portion of sales. Days cost of goods sold in inventory gives us an indication of how much inventory do we need to keep on hand at any given time to generate annual activity. And days cost of goods sold in payables gives us an indication of how long are our payables outstanding. How many days does it take us to pay our payables? Profitability ratios give us an indication of the profit that we're generating through our operations. Gross margin is gross profit divided by sales. So here we're looking at the top section of the income statement. Only one expense factored into this calculation is cost of goods sold. Then moving down the income statement, operating margin is operating profit as a percentage of sales. So at this point, we're looking at all of the operating activity, not taking into consideration financing or taxes. Moving down to net margin, net profit as a percentage of sales. That considers all components of our operations, the operating expenses, financing expenses, and the tax situation of the company. Return on equity is net profit divided by equity. This gives the shareholders an idea of what are they getting for their investment in the company. And return on assets is looking at operating profit, that is before considering financing, as a percentage of total assets, without factoring into total assets what is financed with liabilities, what is financed with equity. So return on equity focuses on the return to the equity holders, and return on assets is looking at the return on the overall asset base of the company, disregarding how that asset base is financed. And finally, one market ratio, the price-earnings ratio, which is calculated as stock price available in the markets, probably most easily accessed by looking online, divided by earnings per share. This gives a shareholder an idea of the relationship of how much money is invested in one share of stock relative to what the earnings that accrue to that one share and ultimately to that shareholder are. The higher this ratio, the higher potential growth there is in the company, usually. The lower the ratio, without knowing anything about the growth of the company, the better for the shareholder. They invest less to get more earnings. But high growth companies usually result in a higher than average price-earnings ratio, which investors accept because they know that earnings is likely to go up over time, and they'll have some additional benefit from their investment beyond just a static earnings per share amount that doesn't change. Rather, it will increase from year to year. So we've looked at the concepts and the formulas relating to ratio analysis. When we meet together in class, we're going to work through a lot of examples of doing these calculations, looking at financial statements, completing the analysis, so you know how to apply these concepts in a real company setting, and I look forward to seeing you then.